Hello, business builders, and welcome to Business for Breakfast, where business is the most important meal of the day. I'm your host, Aaron Novinger, the Venti Business Guy. Our goal in this channel is to give you a ton of micro lessons to help you mind your own business. Hang out with me today as we drive and dive. We drive and dive into topics for our everyday business owners, especially our mom and pop venti shops. This is for you. Today, it's our third part of our series called the Biz Tax Crash Course. This is the 301 course, so let's buckle up and let's roll. All right. So, let's first understand the mindset of the business owner when it comes to accounting and finance, okay? And again, this is coming from a guy that honestly does not like dealing with that stuff at all, okay? So, for me, you guys understand that just because you're great at starting businesses or making money, I think we have a good fundamental concept or ideal that the skill of making money is not the same thing as the skill as managing money, right? You guys get that? That's why every performer, athlete, singer, superstar has a money manager for a reason, okay? So, now, think of accounting, I don't know, like the vehicle that you drive. Okay, you guys know, I'm driving a car right now. I think we understand it, we get it, makes sense to us, right? And how do we know how the car is operating appropriately at its optimal? How does that look? How do we know? It's our dashboard, right? It's the dashboard. It's this thing here that we're looking at. And so right now, I have a warning light right here on my dash, and it's because I have the turn signal bulb is out. So there is a light on my dash. Okay, you get it, right? Okay, it's just like driving a car, right? The accounting piece, and we talk about it all the time, the 7 plates of business. We always say in order, the most important plate is plate 1, which is the trade. That's the business that you run day to day. But then right behind it is plate 2, which is the accounting plate. Because this plate, if you don't know how to interpret the data from your dashboard and the warning lights, it is quite literally the one plate that'll sink you faster than all the other 6 plates. Plate number 1 will sink you the fastest if you don't know your own trade, but plate 2 right behind it. So that's what today is. Today is I'm going to help you make sense of a lot of the terms and everything, because to be honest with you, I hated the fact that as a business owner, nobody helped me. And the accountants always spoke over my head. I didn't even know what they're talking about. And so today, this lesson, it's going to be in depth, but it's because I really want to break this stuff down for you to really help you grasp and understand this concept of accounting, because it's not that difficult. If we understand, it's broken down to a few components, okay, high-level components. Today, in our 301 course, I'm breaking this into 15 different sections. I'm not kidding, man. Today is going to be awesome. And again, I just put me on 1.5 speed. I don't know if you can actually hear me at 2 speed, but 1.5 should be fine. So let's jump into this thing and let's understand our dashboard and what all of these little warning lights and everything mean to us, okay? What is a profit and loss statement? What is it? What's the P&L statement, right? Look, this is easy, okay? You also hear it called the income statement, the statement of earnings, right? But it's quite honestly one of the most important financial documents, if not the most important financial documents in your business, okay? Most business owners that understand this understand the importance of the financials. Most business owners understand the importance of the profit and loss statement, not necessarily the balance sheet, but we're going to talk about that here in a second, okay? Right, so the P&L, your profit and loss statement, think of it as your business's report card, okay? Just like we were in elementary school, I've been alive long enough that I remember in elementary school getting my report cards, and they were handwritten. And so it was all the subjects, and then the teacher would mainly write in the gray, and right next to it was each semester for each class, my code of conduct. And honestly, coming from military parents, my parents cared about my grades. My mom cared about my grades. My dad more cared about my conduct. So I was never really worried about bringing home a bad grade. I was more worried about bringing home a bad score for conduct, because my dad would tear my tail, playa. He would tear my tail if I brought home an N for needs improvement, or the unspeakable letter of the entire alphabet growing up. If you in your 40s, what letter I'm talking about? What is it? In the comments, you guys know what it is. Put that letter. U. Unsatisfactory. Woohoo! You brought home a U. Okay? It was the death sentence, because that actually meant you disrespected your teacher, and my dad would tear me up, playa. Okay, so we're going back to the P&L statement. It is the report card, but let's break this bad boy down. Okay, so let's say you are a solopreneur, and you're doing like commission-based sales. Okay, you work for a company. They pay you $10.99. Maybe you're a traveling doctor. Maybe you're a traveling RN. But you basically are a traveling person, and you are commission-based, meaning they pay you a certain amount per sale or a certain amount for your hours worked, but it's still a commission based off of your performance, right? Okay, so let's say last year you brought in $78,000 for revenue, okay? So you understand a P&L statement is real simple, and by the way, all businesses have them, and so do all personal households, because it's the same thing. So all individuals, all households have a profit and loss statement. So just think of it as three parts, right? So the first part of this is all the revenue sources, and that's the top. And then right below that, right below all your revenue sources, before your expenses, there's a little line item called COGS, cost of goods sold. And so if you're let's say you're a furniture company, and you typically have a 100% markup on your furniture. So let's say you're selling something for $1,000, okay, and you sold it for $1,000. Top line revenue is $1,000, and then you have COGS, cost of goods sold, and let's say the piece of furniture was $500, and that goes right there, okay? Because it's not like you can actually use that money. You have to use that money to pay for the item you just purchased. That's COGS. So it's your total income minus your COGS, then minus your expenses. And then there's a hard black line on the page, and beneath that is the profit or loss, okay? All right, so going back to the example where a commission-based sales individual or traveling healthcare professional, but last year you brought in $78,000 in revenue. So on your profit and loss statement, that could look like where it's, okay, $78,000 top line revenue, and it's a service-based business, so there's not really going to be COGS that you have to pay for. So take top line revenue, subtract COGS, which in this case is going to be zero, and then we have our, basically not our gross revenue, but now our gross profit. Minus COGS, gross profit. Got it. Okay. Now let's break down our expenses, right? So what would be the expenses that we would deduct from our top line revenue of $78,000? All right. Let's say automobile expenses, and I'm going to give you guys some easy ones, right? So this is easy especially if you're a traveling healthcare professional, or even like a traveling maybe salesperson. But auto expenses, that's basically for anybody. And so let's just say for last year, you added it all up and it was like $5,000. Okay, cool. Then you've got right beneath that would be like labor. Like a lot of people like real estate, you've got transaction coordinators. So a lot of times, even though you're a solopreneur, a lot of times you've got a team of individuals that are contract labor that are also like you, solopreneurs, that help you run your solopreneur business, okay? And a lot of us like me, man, I don't know, I probably have a dozen contractors that I can just call up, hey, I need this graphic put together, no problem, they send me an invoice, done. Okay, that's contract labor, right? So that's what I'm saying. So we had $78,000 in top line revenue. Then we had a $3,000 for expenses, like our marketing expenses. And then we basically had $5,000 for auto expenses. Then we had, like, let's say $8,000 for contract labor, all the different individuals, independent contractors that basically we work with that help us run our business as efficiently as possible, because we don't have the money to pay these people to be full-time, so they help us out typically on a contract basis, right? Usually when you hear like contract labor, it's because they're helping you out on a project/contract basis, right? All right, so we've already covered the top line expenses, but we've also got a few others. Like, what about office supplies? Okay, usually it's a couple $100 a month for that. Trust me, one ink cartridge that goes out, you can blow a really $1,000, $2,000 annual office supply budget. Okay, but what else? How about meals and entertainment? We covered a lot of these topics in a previous session. What about your utilities? Okay, let's say we've got utilities of a couple $1,000 or $1,500, and let's say maybe we've got meals and entertainment for $2,000. We've got supplies at $2,500, contract labor maybe, I don't know, $8,000. Basic auto expenses of $5K, and let's say advertising marketing expenses of $3,000, right? Add up together, total expenses, call it $22,000-ish, right? So really, after deducting the expenses from top line revenue, our net operating income, right, is going to be $55,000-ish, okay? But hold on, there's more. Okay, so we've got other credits that we can basically take advantage of, right? That will count as, but here's the thing. Let's just say you had other revenue that came in throughout the month, like rebates or things like that, or credit card rewards or things like that income, okay? So you got to make sure that we count that, right? Rewards, so that's going to go into other income. So don't forget, total revenue, that's selling your product, but you know that you actually make other revenue sources other than what you sell stuff for. Rebates, things like that, okay? Credit card rewards, you still have to count it, but it goes into other income. It's in a different place, okay, on the profit and loss statement. But that's going to bring our total net income from what 55.8 is, I think, where we're at, to like more like 56.1. Okay, you grab a few $100s of rebates and credits and things like that, and you still got to count for it, but you've got to count that income in a different place. Okay, so just keep that in the back of your mind. All of us have those little rando revenue sources that we have to count, but you can't count it in top line revenue. Got it? Okay. So I think let's talk real quick about why understanding your P&L matters. Okay, your profit and loss statement. Number one, it helps you track your profitability. Okay, think of it really. It really does three things for us, almost in order. Okay, so one, it helps you track your revenue and your profitability, because at the bottom of your P&L is your profit or loss for the month. Okay, but your profit. And typically businesses that are multi-year businesses, you take that, we're moving into the month of March. So you typically you'd look at last month's compared to this month's, but you would really also look at last March compared to this March, right? And because oftentimes most businesses have cycles, flows, if you will, kind of rhythms of cash flow, and accounting is no different than most businesses. And so looking at the previous month, if you look at our month, and just we should be consistent, if you look at our revenue in February compared to our revenue in April, come on, playa, it ain't even close. It's not even the same business, because one's without tax revenue and one has tax revenue, right? So, but the three main reasons why we have to understand our P&L, one, track our profitability. We get that, right? But tracking the profitability right there helps you do what? Identify unnecessary costs. That's a piece of this. When you get your P&L, this should be something that you're doing. You're identifying your unnecessary costs, okay? Now, seeing your profit, so it's seeing, understanding, and then executing. Seeing, understanding, executing. If you understand your P&L, you should not only see certain numbers, but you should understand what they mean that causes you to need to execute on something. There should be a cause, right? And that's the third thing that we have to do is make some decisions based off of unnecessary costs. And to be honest with you, I know most small business owners are pretty hard-headed and don't like being told what to do, and they tend to run their business based off the cash flow they have, and they're always in a panic. Okay? This is from my experience of being a small business owner my whole career, and knowing 1 zillion friends of mine that are small business owners, and having 1 zillion clients that are also small business entrepreneurs, and having 1 zillion conversations with them, understanding what they deal with on a daily basis, okay? And most small business owners don't like being told no. It's true. one of the most important things a small business owner can do is put together a budget committee. Honestly. And one of the largest companies that ever walked planet Earth was Standard Oil. You know that when Rockefeller died, he was worth Musk and Bezos combined? Yeah. And you know, my boy was obsessed with saving pennies. That's right. Never cared about the money. The most important thing that he did was have an executive council when it came to decisions, and had a budget committee that was a different set of eyeballs that had access to the P&L and would regularly study it and make suggestions on how to save money. Okay? So, understanding your P&L, reading it, understanding it, and then executing on it. Okay? So, if you know how to read it, understand it, there should be regular adjustments that you make, keeping yourself on track. Okay? So, we've got to make sure that we look down on our dashboard, analyze it, where we at, what's our speed, what's our RPM, what's our fuel, what's the temperatures, and then we got to be back out. Remember, the purpose of our financials is not to spend every waking second studying them, because if you did, you'd crash. Okay? Because I need you understand, like 90-10. So spend 90% of your time on plate one, and then spend the other 90% or the other 10% focusing on accounting and some of the other plates, okay? But just try, if you can, spend most of your time focused on the trade, keeping your eyes on the road. But again, let's focus on understanding what the P&L is. Now, we're gonna shift into section 2, which is really having an understanding, a deep understanding of a sole proprietorship versus an S-Corp, okay? And it's really what you as a small business owner need to know, right? You have to understand that as a small business owner, choosing your right structure can and typically does have a pretty tremendous impact on how your business runs or handles things like your taxes, your income, and your financial reporting, okay? So most small business owners start their business as an acorn and then grow it into this big oak tree. But usually when you start, most of the time you start as a sole proprietorship, right? But as you grow, when I say sole proprietor, it's sole proprietor, comma, LLC, okay? Because an LLC, again, from previous, the 201, you understand how it's taxed, okay? So it's taxed as a sole prop. So when I say sole proprietorship, or sole proprietors, I'm also talking LLCs. And then as you grow, then we talk about switching into an S-Corp, okay? An S-Corporation, to take advantage of different tax benefits, okay? All right, so now here's the good news. Whether you are a sole prop or an S-Corp, right, your profit and loss statements look almost exactly the same, okay? The differences really start showing up really in how you pay yourself and how your business income is taxed, okay? But let's break this down in a simple way if we can, and we'll look at both as we're doing this, okay? The profit and loss statement is the same for both, right? So the format, right? So it's the revenue, right? Then your expenses. So revenue, income, sales, commissions, blah, blah, blah. Expenses right here. Think like advertising, supplies, utilities, blah, blah, blah. Then your net income. And that's what's left after these expenses are deducted. So revenue, expenses, hard line on the page, and here's our net income. And it can be positive or negative, but this is the net income, okay? And for the sole proprietor example we talked about before, if your business made $78,000 as a traveling sales rep or a traveling healthcare provider, right? And then you had those $22,000 in expenses, your net operating income is going to be $55,008. Remember, if you also earn that $300 in kind of rewards and rebates, total income's like $56,100. Remember that example? Okay, so small business owners, right? So the P&L looks the same, but we got to talk about how the income rolls to us and how we're taxed on it, okay? So even though the profit and loss statement stays the same, the way you take the money out of your business, okay, changes based on your business structure, okay? You get this, right? Okay, so based on your structure, this kind of changes how we grab the income out of the business, okay? As a sole proprietor, remember, the business is you. You're the business. Remember we said this before. The highest taxed entity in the United States of America is a W-2 employee, and a sole proprietor is a W-2 employee of your own business, okay? The business and the owner are, ready for this, the same, are legally the same entity, okay? Sole proprietor. That's different than an LLC, okay? An LLC, the business is its own entity, okay? But both of them are taxed the same according to the IRS, right? So when we're looking at this, understand what we're talking about, okay? A sole proprietorship, you pay yourself through, write this down, owner draws, okay? Owner draws are not considered a business expense, okay? Which means you can't reduce this from the taxable income, okay? Hear me on this. Profits are taxed as personal income on your tax return, meaning you're paying all the self-employment taxes of 15.3%. That's right. That's right. You paying it, all right? So remember our example, in the sole proprietor example, from grossing $78,000, taking $22,100 from expenses, adding $300 in rebates and stuff and rewards. Now we have $56,100 in profit, right? You take that out as owner draw, right? But you have to pay the self-employment taxes of 15.3%, okay? Now, and again, that's the same thing as an LLC, because an LLC is not a taxable entity to the IRS. The LLC, when you form it with the state, an LLC is only state recognized, and we cover that in the 201 crash course before this. But let's move into S-Corp, okay? So so remember the sole proprietor, you are the business. An S-Corp, you are a shareholder in your business. They are separate entities, okay? The business is legally separate from you, okay? And you pay yourself in two ways. One, salary, okay? Call that payroll, think W-2, okay? And it's got to be a reasonable wage that you pay yourself, right? So this is one of the most difficult things that small business owners forget to do, and it really burns them in a couple ways, because S-Corp, do you have to technically legally put yourself on W-2? There's not going to be like somebody showing you at your door to make you do it, but the IRS will audit you, okay? They will, because when they come in, that is one of their big things, is they're looking to see, does it make sense? The first thing they look at is, were you working in the business 40 hours a week? And how they can tell is, what do you do in the business? And trust me, you'll tell them when you get audited. You have to, okay? You don't lie to the IRS. And so they'll find out, oh, because you're sitting at a desk answering the phones. So if you had a full-time job and this was an absentee-run business, would you have to hire somebody to do your job? Most of the time, the answer is yes, okay? If you do, okay, then you've got to basically, okay, how much would you pay that person? I don't know, $12 an hour, $15 an hour? Great. That's what you're going to pay yourself on payroll as the business owner, even as an S-Corp. That it's a small amount, okay? And then you basically, the rest of it is paid out as shareholder distributions. So write that down. Shareholder distributions, okay? And these are basically additional profits that you take as the business owner, okay? But remember, this is a shareholder distribution, not payroll. Only your salary is subject to your self-employment taxes. Distributions don't have the self-employment taxes, okay? They're taxed at a much lower rate, and sometimes not taxed at all for certain taxes, okay? No kidding. Okay, so this is why it's so important that we kind of really figure this out. So going back to our example, we've got an example where we have $56,100 in profit, but you might only pay yourself, call it $25,000 for salary, okay, and you pay your self-employment taxes on that, but then that would leave like $26,000 as shareholder distribution, saving all of that self-employment tax of 15.3%. Because remember, you're the owner of the business. So when you work for a company's W-2, you pay half of the self-employment taxes of 15.3 as the employee, and the business pays the other. But if you're a sole proprietor, and that's how you're taxed with the IRS, every penny of that, the IRS says, oh, it's all W-2, so you have to pay 15.3%. Come on, man. I'm just trying to pay my bills and take care of my fam. That's all I'm trying to do, right? So again, the purpose of this tax course, there is a small, tiny line between tax avoidance and tax evasion. One is what every billionaire does, and one is what Al Capone did. One is legal, and one is illegal. You're talking to one of the few guys that's been through not one, but 2 IRS audits. So this is about making sure that you can defend yourself in an audit, right? Now, let's shift, shall we, over to the balance sheet, okay? While the profit and loss kind of tells the story, think about it telling a story, think of it as a video, okay, of the business's kind of performance during the time frame of that video. The balance sheet is more like a photograph, a picture, a snapshot, okay? So remember, the financials is the video, a certain length of time, but for us, usually it's month by month. It might be a month's financials. It could be a year to date, things like that. But it's like a movie with a beginning and an end, and you're looking at your money during that time frame. But the balance sheet is it's the Polaroid. It's the snapshot, okay? And it does a really good job, shows you what the business owns, right? So all the assets. It also shows you what the business owes, right? And then what's left over, which is equity. So the balance sheet is the snapshot, the Polaroid of what the business owns and what it owes, okay? And then what's left over, what it owns, what it owes, and then what's left over. All right, but let's break down what a balance sheet looks like. And you've seen them a million times. You own a business, you've had one set of financials, you know what it looks like. And I know, because it's a thing you look at, don't know what it means, and you throw it away, okay? But it's typically like 3 categories. Like it's usually on 3 pages. It's a spreadsheet. If you're using QuickBooks, it's not a spreadsheet, but it's categories, okay? You've got these categories, right? So I'm gonna give this to you like the different categories of your balance sheet, but I'm gonna talk about it like from a sole proprietor and then an S-Corp perspective, okay? So our categories, right? So think of like liabilities. And if we're looking at a P&L, how they're different from a sole prop to an S-Corp, okay? So we're looking at assets, right? So remember what we own, what we owe, and then what's left over, right? Own, owe, and left over. Oh my gosh, you're gonna be saying that all day long. You're like, over. Okay, anyway. Assets, what we own, assets, cash in the bank. What do you have? This is what you own, right? So sole proprietor and S-Corp, they're the same. So let's just say you got $6,000, okay, cash in the bank, cool. On your balance sheet, it looks the same for the sole prop and the S-Corp, okay, we get that. Liabilities, what we owe, not what we own, what we owe, okay. And let's say with credit card debt for both businesses, maybe $1,000, okay? We have an idea on, now let's think of one of the things that we see on the balance sheet, owner contributions, okay? On a sole prop, you'll see owner contributions on the sole prop balance sheet, okay? You get this, okay? You won't see this on an S-Corp balance sheet. That's listed separately, okay? But this will be on the sole prop balance sheet, okay? Owner contributions, okay? Now, owner draws. Remember, owner contributions, that's money you put in. As the owner draws, you will see something called owner draws on your sole prop balance sheet, but not on the S-Corp balance sheet, okay? Owner draws is money you as an owner take out, okay? Take out. And this is as a sole prop, okay? Now, let's shift over to on a sole props, or an S-Corp's balance sheet that you won't see on a sole prop, okay? Shareholder distributions. You're never going to see that on a balance sheet of a sole prop, but you will see that on the balance sheet of the S-Corp, and that's the money taken as profit, okay? Which again would be like owner contributions for the sole prop's balance sheet. Got it? Okay. Now, retained earnings, right? 0 for both. There's none for the sole prop, none for, on this example, or that the S-Corp. And you'll see that also on both balance sheets. Net income on both balance sheets, right? We talked about this before. Net income for both is $56,100. And the equity, after you take up all of that on the balance sheet, what's going to show is total equity. Call it $4,900, okay? $49,500, right? Right. Balance sheet follows the same structure for both business types, how the money's classified. Now, here's where we have to determine which option is best for you, sole prop or the S-Corp, okay? So if you are a solopreneur and here's the kicker, if you're making under $40,000 in profit, okay? Under $40,000 in profit, staying as a sole prop might make more sense for you, because don't forget, as soon as you do the S-Corp, yes, if your business is bringing more than $40,000 a year, 9 out of 10 times it makes sense to move on over to the S-Corp. So we can get some of the self-employment taxes away from you, take it as a distribution, and kind of, it's just taxed differently, but it saves you money, right? Save that self-employment tax. But so again, going back to, you're a solo business owner, right? But if you're making under $40,000, staying a sole proprietor might be just fine for you, okay, to be honest. But if you're pulling in more than $50K in profit, an S-Corp, 9 out of 10 times can definitely save you thousands in self-employment taxes, like thousands. And a lot of times, yeah, 4 figures, but a lot of times 5 figures a year in taxes. You heard that right. Well, I'm not kidding. It's that much money, okay? So, just to recap, stay a sole proprietor if your business is small with minimal income. And again, it's easy to set up, simple taxes. And you don't mind, this is like, your mindset is you don't mind paying those self-employment taxes on all of the profits coming in, because the business doesn't do that much in profit anyway, okay? We're gonna consider the S-Corp if the business is growing with $50,000 in annual profits or more. 9 out of 10 times it makes sense to move and fill out that form 2553 with the IRS, which tells the IRS, please tax my entity as an S-Corp, okay? And 9 out of 10 times we're gonna reduce that self-employment tax. But understand, one of the compromises, okay, it's a little bit more paperwork, it's a different tax structure, we've got payroll requirements, but what you typically pay annually in the additional tax return and the IRS for payroll taxes and requirements is typically way outweighs what you save in taxes, like the benefits of doing a little bit more work and what you save in taxes, okay? So wrapping this up, right, at the end of the day, both of the entities, the sole prop and S-Corp, really do follow the same basic accounting principles, but they really impact your taxes and mainly how we get money out of the business, okay? Rule of thumb, business is growing, we got more than 50K, we go S-Corp. If we're just starting out, we want to keep things small, sole proprietor. These are like when you go to Vegas and they give you the rules for playing blackjack, okay? These are just like the rules of business, okay? Doesn't mean you have to follow them, it just means you can start here. But really, honestly, whatever you choose, understanding your numbers is literally the most important thing. Okay. That wraps up section 2. Let's move into section 3, right? I told you, this is a course, man. I'm giving you an entire semester's worth of information in this. You better be taking notes like a madman, okay? We're gonna move into section 3, which is explaining in more detail the balance sheet, okay? So, as the owner, you really need to know where your business stands financially, right? And at any one given moment in time. Again, the photograph, okay? And so understanding the balance sheet is a report card during a certain time period, giving the grade over the time. The balance sheet is what's it look like today, okay? Knowing it's that snapshot. All right, so the balance sheet is really one of 3 core financial statements, right? So the profit and loss statement, we get it, right? We've got the balance sheet, profit and loss statement, and the cash flow statement. that does a good job of summarizing your financial position at a specific date, okay? So the cash flow statement summarizes everything, okay, on a certain date, okay? But the balance sheet, remember, has three main sections: assets, liabilities, and then equity. Assets, what we own; liabilities, what we owe; equity, what's left over. Come on now, right? You get it, right? The value of your business after everything is left over, okay? It's a very simple formula. Assets equals liabilities, right? What we owe plus the equity, what's left over, equals your assets, okay? So just, it's a very easy formula, right? I just put on a piece of paper like AS equals LE, L-E, okay? And you get it. So it's not difficult to understand. The assets, really all of the resources really have to be funded really by either money you owe or money invested by you, or shareholder equity, other people that invest in. But that's how it adds up. So when you understand that, then it makes a little bit more sense. You tracking what I'm saying? Okay. So breaking down a balance sheet, and we'll do it by example. Okay. And so going back to what we talked about before, our previous example, when you can carry over the same numbers, we talked about cash and bank, what the business owns, right? It's an asset. And we said it was like $5,900, $6,000, okay? So regardless of whether we're a sole prop or an S-Corp, the amount remains the same on the balance sheet, okay? Liabilities owe. We talked about this, what the business owes, okay? Credit card debt, $1,000, okay? Cool. Again, no difference between the two structures, okay? They both owe $1,000 on the balance sheet, got it. Equity. This is the owner's value in the businesses, okay? This is where things differ a little bit, right? So if we think about the categories, and again, based off of if it's a sole prop or an S-Corp, okay? We've got, as a sole prop, you'll see on the balance sheet owner contributions, okay? So for you, if you're a sole prop, you put in $1,000, right? Then we put that on the owner contribution, on that line on the balance sheet, okay? Cool. Now, it's a little different if it's an S-Corp, okay? And a lot of times we'll divide that between two things. So the owner puts in money, the $1,000. There's a couple line items you're going to see on a balance sheet for an S-Corp that you typically don't see on the sole prop. One of those is capital stock, and the other one is APIC. Okay, so say like capital stock, so out of the $1,000, maybe $100 goes allocated to capital stock, basically, right, in the business. And then the other $900 is going to be into the APIC, right, which is, that stands for additional paid-in capital. Okay, so APIC, right? So additional paid-in capital, right? And that's the other $900. Again, that's on an S-Corp's balance sheet, okay? Not on the sole prop. Now we go down to how we get paid. Okay, one is how you put in money. The other one is how we get paid out of this. Sole props, right? $52,100 was profit. Remember that? On the balance sheet for the sole prop, that's considered owner draw. You're not going to see that on the S-Corp, right? You will see that on the sole props, right? Balance sheet. On the S-Corp, you're going to get paid, and it's going to basically, you're going to see that in shareholder distributions, okay? But both net income is the same for both, okay? Total equity is the same for both, about $4,900 when you net it all out, okay? But remember, the difference is in how the owners get paid, okay? So, how business owners take money out of their business, this is where the magic happens. The sole proprietor is going to take withdrawals through the owner draws, okay? And remember, that's all taxed with self-employment taxes, okay? Or the S-Corp, okay? So how business owners take money out of the S-Corp, right? They take shareholder distributions. Again, typically more tax efficient, right? Net income is the same, carries over the balance sheet, okay? So the net income from the profit and loss statement, right, always appears on the balance sheet, okay? But again, in this case, both businesses had $56,100 in profit, reflected in total equity, okay? But the key takeaway though, even though the profit and loss statements look the same, how money is classified on the balance sheet changes based on how the business is structured, okay? We get this, right? And again, talking about why this is important, okay? The balance sheet, and why we talk about it and why it's so important, its purpose is to measure the solvency of the business, okay? It really shows if there's enough assets to cover the debts, okay? It's really easy to see this in publicly traded companies because this is posted quarterly, okay? Why else is this important? It helps with growth planning, okay? So typically lenders and investors use the balance sheet to assess the financial health of the business. And again, the third thing, like the profit and loss statement, it should help to helping you make decisions that help you execute in your business, okay? Do we need more capital? Do we need to reduce expenses? Can we afford this expansion? You get it. That comes from the balance sheet, okay? But the rule of thumb is simple in the business. If your liabilities are too high, your business is in financial trouble, right? You got to make sure, keep your assets higher than your liabilities. That's what everybody's looking for. Assets higher than liabilities, okay? But remember, as we're driving the car, right? So we're basically spinning plate number one, which is the trade, okay? What we do every day running this business, your job is to keep your eyes looking out of your business, watching it. Remember that 10-20% of the time you're looking down at your dashboard, you're trying to figure that out, right? But you still have to keep your eyes on the numbers, right? So even though the balance sheet and the financial, your profit and loss statement, your financials might seem intimidating, and they are, and trust me, it is. Once you understand what this stuff means, it just becomes, I don't know, it's like this. You guys remember the movie Elf? And do you remember how Buddy was petrified over the radiator? And then he called his dad. He's like, that thing over there is making a horrible noise. It's like, ee, ooh. And the dad's, it's just the radiator. He's like, no, it's not. He's like, yes, it is. And he went over there and said, oh, it's just the radiator. This is just the radiator, man. It's not this horrible monster in the corner making noises. It's just the radiator, okay? It ain't a big deal. Just keep a quick overview of this, right? We got to keep our eyes on the road, running the business. 10-20% of the month, we're looking at the other 6 plates, really focusing a lot of that time on the accounting plate. We got to make sure that we keep our liabilities in check. We got to monitor that cash flow statement, right? We got to make sure we use our equity smart, right? We want to be wise in how we do it. But regardless of whether we're a sole prop or the S-Corp, understanding that balance sheet is going to be crucial into managing the business long term, okay? Let's move into section 4, okay? I'll make this 301 will be in basically 3 sections. I'll do 1 through 5, and then I'll do 6 to 10, and then 11 to 15, okay? This is section 4. And this is really dealing with the year-end financial statements, okay? And really the impact the year-end financial statements have on the business, okay? And not enough of our business owners do this, where we're having the sit down of let's look at everything and do an evaluation. But as a business, we tend to really, I say as a business, or more specifically to us as the entrepreneur that's the business manager running the business, we tend to be focused more on day-to-day stuff like sales, expenses, running the business, right? You're almost like the president and CEO until you get to a certain size, which is the president, CEO, or these are the 2 individuals that literally run the day-to-day and have the temperature of the day-to-day of the business without question, right? But what happens at the end of the year is just as important, okay? Because as January 1st rolls around, your profit and loss statement resets, which is cool because it's like the New Year's resolution. Today is day 1, right? But your balance sheet still carries forward the figures from last year. So it's like January 1, we're like, today is a new day. This is a new year. I can't wait to get to the gym. Bam, day 1. And you look in the mirror like, but I'm still like 40 pounds overweight. I'm still pale, and I still have a lot of wrinkles and sunspots, okay? So it's like the P&L's like, brand new day, we're fresh. And the balance sheet is like the SNL, like Debbie Downer. Wah, wah, wah. You get what I'm saying? You guys know what I'm talking about. It's one of the most famous skits where everybody loses it. All right, but understand that balance sheet though really is, it pulls it all together and it really just keeps that hanging out. The annual though is really, it's resets more than just the accounting technicality piece of it. It's really a really powerful way to track your business's like long-term financial health. Like getting your annual physical done at the doctor, but then you log it every year. So by looking at the annuals every year, like logging your physical health, logging the business health, it's just a fantastic way of seeing how the business is doing every year. It's just doing an annual review of the money, okay? But what kind of happens typically at this time frame? What does that look like? So think of the P&L like the scorecard, okay? So that's like what's the score at the end of the game, okay? We always start each game with 0, and then no matter really how many points is scored, there's always an end of the game, and there's always a final score. It's the same thing on the end of the year financials, okay? Typically, December 31st, at the end of the year, it's going to show all the revenue, all the expenses, and all the net income for the entire year. And then on January 1st, that sucker resets to 0. It's a brand new, fresh start, tracking the new year's income and expenses, okay? So going back to what we said before, a 2023 P&L, revenue 78,000, expenses 22.2, leaving 56.1 for net income, right? But so on January 1st, the P&L, remember we talked about revenue, expenses, net income. Revenue 0, which means, and expenses are 0, which means your net income is 0. That's how it starts every January 1st, right? But again, why is that? And that's because what's the P&L do? It's the movie. It tracks the business performance during a set period of time, right? And again, it's usually for the month, the quarter, or the year, right? So it's cool how that happens. But what happens to the balance sheet at year end, okay? Unlike the P&L that resets, the balance sheet don't, okay? Everything carries forward. All that financial data carries over till the following year, okay? Cash stays the same. You carry over that 5,900, right, from December 31st. So that's always the same January. Liabilities, right, carries over. $1,000 carries over, doesn't disappear. Shows what we still owe, equity that carry over, and that includes based on how we're filing it as a sole proper S-Corp, which is the owner contributions, or the retained earnings, and then our distributions, right? So the kind of the key change, if we're looking at that, the net income from the P&L moves into retained earnings on the balance sheet. Did you hear me? So the net income at the end of the year, December 31st, that amount moves into retained earnings on your balance sheet, okay? So if we're looking at the categories on the balance sheet, right? So cash, the assets, 5,900. Liabilities, what we owe, 1,000, leaving 56.1 for net income, okay? Total equity being 4,900. But on January 1st, when we look at this, the net income of 56.1 disappears, okay, from the balance sheet. And remember, it's like you cut and then you paste. So you copy it, delete it, and then you paste it into retained earnings on the balance sheet, okay? So even though the total equity stays the same, it just changes how it's categorized, right? So we're moving money from the checking account to the savings account. From the P&L, think of that like the checkbook, over to the balance sheet, think of that like the savings account, okay? Makes sense? And now that's how we're able to put it in ledger and save it like long term, okay? But again, why does it matter? Okay, we're like, why does this stuff matter? Because it helps you as the owner track your long-term financial health, okay? Because even though the P&L resets, your balance sheet really helps you see the bigger picture, like zooming out, you like zoom out, and like now you can see more high level, like here's a 5,000 foot view. But remember, it also helps you plan the growth of your business, because by looking at the retained earnings, you can decide on how much to reinvest back in the business versus taking as a distribution. Okay? Making sense? Okay? Really, it helps you understand that. And it also basically, at any time, it keeps you ready to do your income taxes. Like, you're tax ready. Okay? Your year-end balance sheet really is one of the most important things we look at for tax filings. Okay? Because it shows us the assets, the debt, and the retained earnings that we have. And again, one of the biggest mistakes our small business entrepreneurs make, they only look at their P&L and they ignore the balance sheet. Don't be one of them. Don't do it, okay? Don't. Your balance sheet shows you whether or not your biz is really growing over time. And remember, healthy things grow. Look at your balance sheet to see if you're growing. That tells you if you're growing, okay? That's its job. Couple of the kind of little takeaways for this, if we're thinking like year-end accounting, right? Let me just kind of make this simplified for you, okay? The P&L resets at the start of the year, okay? Typically tracks only new income and expenses. Your balance sheet carries over all of the assets, liabilities, and equity. The net income from the previous year moves over to retained earnings. And the most important thing is tracking these changes helps you as the owner mind your own business by helping you plan the growth of your business, help you manage your taxes for the business, and more importantly, helps you make decisions, informed decisions about your business. Okay? Is this making sense to you? Now, let's move into the last section, 5, and let's jump into this bad boy. Okay. Last section of part 1 of our 301 course, okay? And this is like the accounting equation, okay? So this is really the foundation of small business finances, what I'm about to jump into here, okay? Understanding this formula is really like knowing the rules of how to play the board game, okay? The good news is this thing is super easy. Remember what we talked about it before? ASS equals L plus E, okay? Your assets equals your liabilities, right? So your assets, what you own, equals what you owe plus what's left over. That's the equity, okay? This sucker is like the bedrock, the building block of the entire foundation of this house that you're building, okay? And by the way, this holds true for every business we look at and every transaction you make. It's always the same, okay? But what do these things mean, okay? We've talked about it before, but an asset, again, it's what the business owns, but what does that mean? Okay, here's some things. Cash, inventory, equipment, and then accounts receivable, money that's owed to you, okay? So cash in the bank, inventory and product that's sitting in your warehouse, equipment that basically helps you produce your widget, right? And then what people owe you, contracts and stuff, okay? Liabilities, what your business owes, okay? Things like loans on the equipment that's an asset, credit card balances, lines of credit, unpaid bills, liabilities, okay? And then remember, equity, what's left over, okay? So think of it like a house. House itself is the asset. 123 Jumanji Lane, right? Springfield, anywhere Texas, anywhere Missouri, anywhere US, okay? The house is the asset. The mortgage is the liability, what we owe. So the asset is what we own. Subtract the mortgage, what we owe, and then what we have left over is the equity. That's the part of the house you truly own, okay? As what we owe goes down, the equity, what we have left over, continues to increase. So the same logic applies to the business, right? So if the company has, let's say, $50,000 in assets, right, and owes, let's say, like $20,000 in liabilities, the equity, what's left over, is $30,000, right? You get that, right? Makes sense? Okay, same thing. All right. Now, move into the expanding this formula, this ASS equals L plus E, okay? Equity isn't a constant number. It's not static. It changes. and it changes all the time, and it changes based off of the business's activities, okay? That's why you typically, yes, S equals L plus E. It's a very simplified formula, but let me give you a little bit more complex way of seeing it, okay? So take that formula and let me give you the more expanded version of the formula, okay? Equity equals, are you ready for this? C plus R minus E minus D, okay? C plus R minus E minus D. Capital plus revenue minuses your expenses and minus your distributions, okay? And we know capital, that's the money that you invest in the business. Revenue, that's the money that the business earns from selling your product or service. Expenses, right? That's the amount of money it costs to run the business, like the rent, supplies, salaries, blah, blah, blah. And then distributions. That's the money that you would draw from the business for the owner, okay? So, quick example, let's say the business starts with $10,000 in capital, right? Over the year, the business earns $50,000 in revenue. Let's say we spend $30,000 in expenses, and let's say we take $5,000 for ourselves, right? So then we basically take the formula, so we do 10,000 capital, right? Plus, so it's C plus R, so 10,000 plus revenue, 50,000, minus E minus D, okay? Minus expenses, which is 30,000, minus distributions, which is 5, okay? That leaves us 25,000 in equity, okay? That means in the year, you own 25,000 worth of value in the business, right? So the value of this business after all of that is like 25K, okay? But why is it important? Because again, it helps you know your business's financial health. Hello. If the liabilities are greater than the assets, the business could be in trouble, right? It helps you make smarter decisions. Should we reinvest some of the profits or take distributions? You see this all the time with publicly traded companies. When they have an enormous amount of cash and they have nowhere to put it, what do? Stock buyback. They put it back in the business. They reinvest the profits, right? And it also helps you prepare for growing that darn business. You got to remember, like your investors, your lenders, the accountants, they all look at this equation to assess the value of your business, okay? And it's one of the most common mistakes business owners make. They withdraw too much from that business for themselves, and they don't realize it's killing their equity in the business, which is the value of the business. So remember, keeping a very close eye on the equity and really the equity equation, right? This formula balance really ensures that the business stays strong, like really strong for a long time, okay? So little takeaways at the end of this little section. Remember, AS equals L plus E, assets equals liabilities plus equity. Remember, it always balances. Doesn't matter the size of the business or how long it's been around, it always works. Then, equity changes based on our revenue, based on our expenses, and based on the owner withdrawals, okay? And don't forget that tracking all of this helps you grow your business and, more importantly, avoid the financial missteps. Helps you avoid Murphy's Law. The dude does not knock on your front door if you guys do this. You guys get this, right? Okay, been on for a while. I'm gonna get off here. That wraps up the first part of our 301 Biz Tax Crash Course. I can't wait to jump into part 2, and we're gonna cover basically sections 6 through 10, and then part 3 is 11 through 15. With that, guys, I'm gonna jump off here because you know what time it is. Woo! It's time to get to work.